Slapping on the credit repair label should not entitle payday lenders to a free pass to ignore the Ohio law. Our lawmakers and the Ohio voters did not vote for business as usual. Fortunately, when drafting this bill to close the loopholes in Ohio's law, the representatives understood the various ways payday lenders are getting around House Bill 545. If enacted, the new bill would stop predatory payday lending business as usual and restore the intent of the General Assembly and the Ohio voters. What will this new bill do? Without hurting other legitimate forms of lending, this new legislation focuses on addressing three core elements that have enabled the payday lending industry to perpetuate the cycle of debt. First, it would ban the check cashing fees for the loan. To avoid the new borrower protections, payday lenders stopped issuing loans proceeds in cash and began issuing proceeds in the form of a check, then charging the borrower for cashing the lender's own check, a check that presents no risk to the lender of insufficient funds. That's really the theory behind the check cashing statute, is that if you're a business that's cashing somebody's paycheck, somebody's check from a third party, you're not sure if that check will clear. So having a fee to help cover your risk is viewed as legitimate. This bill eliminates the sham by prohibiting lenders licensed under the relevant statute from charging these kind of junk fees. The other thing the bill does is that the payday lending debt trap occurs when high fees merge with short repayment terms. Currently, payday lenders are charging origination fees, credit check fees, in addition to interest and other fees, as often as every week or two until the borrower's next payday. Such frequent reassessment is excessive, pushing the APR back into triple digits. This new bill limits the origination and credit check fees for loans less than $1,000 to once during a 90-day period. This would allow some leeway for lenders to charge fees beyond the interest rate cap while curbing the likelihood that borrowers will be caught in an ongoing cycle of debt. If these loans are truly about assisting borrowers in an occasional emergency, then allowing small loans with these add-on fees once in a 90-day period should be sufficient. The bill would allow additional loans during the 90-day period, but subsequent loans would be prohibited from charging another origination fee or another credit check fee. This approach will work and will not affect other more legitimate lending practices. And I think when you really think about this particular provision, you know, it makes sense if you're bringing in a borrower for the first time. You take an application, you verify their employment, you check out the checking account that they have, you set them up on your computer system. That's a cost to the business. But do you need to do that every 2 weeks? The same could be said for a credit check fee. You know, if you're verifying all these things about the borrower, is that something that must be done every 2 weeks? Or was once in a 90-day period sufficient? Some lenders, as I talked about, will broker loans ostensibly at 28% and then charge a broker fee that pushes the loan into higher rates higher than what has been permitted, as much as 670%. In worst cases, they can avoid application of most state laws. Based on successful models from other states, the new bill will end these shams in Ohio. In anticipation of some of the questions around the
we appreciate your testimony. Are there any questions? Representative Lundy.
Thank you, Vice Chairman. Thank you very much for your testimony, Mr. Faith, and for you, Mr. Faith. You worked on this issue for quite some time, and even when you were involved in 545, did you ever see the possibility that there would be a fee charged to cash a check in the business's own establishment?
Mr. Chairman, we've actually never heard of that practice being done in any state. So that was not anticipated. So no, we didn't see that one coming.
All
Representative Lundy.
Thank you very much. Through you to the witness, the provision in here for the 90-day period window, I know it was asked by one of my colleagues here on the committee. I just thought I'd give you the opportunity to explain why you think that 90-day window is a workable window.
Mr. Chairman, when the original bill and then subsequent amendments that were tried, that were drafted related to that bill, that's House Bill 209. What I heard was that there were legitimate lenders that have operated traditionally under the Mortgage Loan Act, particularly, that they thought that provision of just saying 28% period on small loans would be difficult for them to comply with, because they even on a small installment loan, 90 days to pay $1,000 back. And I think one of the goals of this bill, one of the goals of the original bill, was to make sure this did not interfere with other, other forms of lending. This was targeted at payday lending and addressing the problems with payday lending. But I also think that it's a reasonable policy to say origination fees and credit check fees, can be added, but once in 90 days is certainly sufficient. Why do we have to, charge those every week or two on a loan? And the bill does nothing to interfere with additional subsequent loans that can be made. The bill allows, as was the ballot issue, for those loans to be made at 28%. So it seems like it's the right kind of balance to not interfere with other more legitimate forms of lending products that are out there, operated, offered by finance companies. But it does go after, this effective product of payday lending, which is every week or two, a new loan, new origination fees, new credit check fees, add to it the check cashing fee. And I think when you look at what has happened in other states, the reality is when they've set rate caps on payday loans, finance company lending goes up. Those are typically installment loans. They have a term, usually 90 days or greater, so that the borrower has multiple paydays to make installments on paying that loan back. In most of those other states, they may have a 25% rate, they may have a 36% rate, but it's not unusual to see in those other states some allowance for origination fee or things of that nature. So it is designed to work in much the same way that small loan lending works in other states, but without having the gouging effect that payday loans have.
Representative Bacon.
Thank you, Mr. Chairman. Mr. Fay, thank you for testifying today.